Hello, it's Caya here. In this video, I'm going to do a tutorial on projecting revenue for a hardware plus subscription business model using our financial model template. Understanding what a hardware plus subscription business model is for example, a business that can sell a device, say a smartwatch or a router for the home, and can then add a subscription on top of that for either all of their customers or some of their customers who choose to add a subscription, to make use of that product. So if you already have the business model and you're watching this as a tutorial video, this is the right place to be. If you don't have the model, I'm gonna link that page in the description. The model is completely free for anybody in our Founders Edition plan and is also available as a one-off purchase if you're interested in that. Also, make sure that you've already watched the video that goes over the basics of how our spreadsheet works, because in this video, we're gonna be mostly focusing on projections and on the revenue sheets. But if you want a deeper dive into the other sheets and how they work, make sure you check that video out first. Link also in the description. So let's get to it. So like I said, this financial model assumes that you have a hardware device that you're selling. And there are two broad approaches as to how the company can sell this device. First, we have what we call self-service or retail sales. So these are sales that happen via marketing, that happen at a retail store, that happen via your e-commerce website. People purchase your device without the need for you to sell it to them with a sales team. There's no sales calls involved in the closing of these deals. So that, of course, again, applies to organic traffic coming to your website, to paid traffic coming to your website, or to retail sales happening at a retail store. On the other side, we have inbound sales. So you could have a more expensive device that you just can't sell on your own. Customers are not gonna purchase on their own. They're gonna have to call you. They're gonna become leads. They're gonna call you, and you're gonna close that deal. This is for more, I don't wanna say enterprise, but larger business type products like, once again, routers or devices that sort of control their building devices, building management devices, and that sort of thing. Usually those would apply on that, where again, they're purchasing your hardware device, your hardware products, but then they're also adding a subscription on top of that. And in those cases, most of the time, those are sold together, right? You're manufacturing the devices, and at the same time, you're selling the subscription, and everybody gets both. On the retail side, that might happen to only part of your customers who choose to buy the device and also the subscription. Let's get started on how these projections work. The first thing we're gonna have here is organic website traffic. So organic website traffic is a global setting. What I mean by a global setting is that it could affect sales of your retail and sales of your inbound sales product. Now, very few companies I expect are gonna have both retail sales and inbound sales agent sales. I expect that will be an exception, but in the end, if there's organic traffic going to your website, it would affect both of them. And that's the reason why organic website traffic is sort of like a global setting outside of those. And the way that works is we're gonna have a starting marketing budget, a monthly increase to that budget, and a maximum marketing budget. So what we're saying here is, well, we're gonna assume that we're gonna start with $1,000, and every month we're gonna add $1,000 to that, maybe 500. And then that's gonna get to a maximum of, I don't know, $25,000 towards the end of the model, or after X number of months. So if you go to SG&A, what you'll see is that expense being added. So when you have brand awareness campaigns, you can see that that number gets added automatically to all the way until it reaches 25,000. Cool. Great. Next up, we have the website traffic that this budget generated. Now, the thing with organic traffic is that it's not directly affected by the budget. For example, if you're focusing on PR, you might get an article that boosts your organic traffic significantly, or if you're doing social media, or if you're doing YouTube, or if you're doing SEO, you might have a video that does really, really well, and then that's gonna drive a lot of organic traffic to your website. There's word of mouth as well. So the point here is the traffic that you get is not necessarily proportional to your budget. There's no cost per click, there's no cost of acquisition here, because it's mostly organic or brand awareness efforts that drive organic traffic. And that traffic increases monthly. So the way we have it here is those efforts are kicking off in July 2021. We have 1,000 visitors at launch, and then that traffic is growing by 10% month over month, all the way to a maximum of 100,000. But it's disconnected from the budget. So regardless of the budget, you're still gonna have that traffic. It's not a direct proportion. You can see it here, the budget and the organic traffic. And you can see that increasing. So what's the point of this? The point of, another way to see it is you could set the budget to zero, quite literally, and assume that you're gonna spend $0 in organic traffic, but that's just not very realistic. it's important that that there's a realistic correlation between not only the marketing budget, as in ads or social media efforts, but also the staffing needed to get to 100,000 visits. But we're going to leave those like that for the time being. Let's assume that there's some organic traffic here. Okay, so let's look into self-service sales first. So once again, these are direct sales that are happening of your device without a sales team, and let's enable it here. Okay, so by enabling that, we have an expected launch, and notice that we have a launch here in February. This is just a placeholder, but the launch is in February, where your organic efforts are in July. So if you go to revenue, you literally see how in February, we're starting to see some retail sales, but organic traffic is only gonna kick in until later, right? So maybe you're starting with only direct advertising. So here's how that looks. So first we have the hardware component. So the hardware component, we have the price to customer. I don't know, let's set that to $49. The manufacturing cost to you. So let's set that to $15 as a placeholder. And then there's the shipping cost, which we'll need to cover. That's $5. And then this is a very cool functionality. We have a minimum inventory order. So a lot of the companies that we've spoken with have this question on how many devices they have to order and how does that affect cash flow. So in here, we've added that. You can set this number to 0. And basically what you're saying here is, well, we are manufacturing the device. We don't need to manufacture in bulk. We can just manufacture as those orders come in, and that just makes it a lot easier. But for most companies, they'll need to order their products overseas, China. So maybe they'll need to set an order of 1,000 products just to do that. So this model has an inventory tracking functionality that's going to be very useful for that. And we're going to see that in the cost of goods sold sheet. So as you can see here, we have an inventory section, and the inventory section says that we're going to have to order devices at a certain point in time, and we're going to add some of those devices to inventory, right? And then that inventory is going to start dwelling down. It's going to start decreasing until you reach a minimum inventory. And when that happens, a new order needs to be set up. So you always have inventory. So that order, we can put a delay on that, or actually we can move it ahead 1 or 2 months, and we can say, well, we need to order those devices early on because otherwise, there's a shipping time to be assumed for, right? So the order number here, as you can see, accounts for that. So let's leave that back to 2 months of manufacturing. And then the cost, of course, the cash flow dip in that order is happening here in the device manufacturing. So you can see inventory and shipping, device manufacturing, and that's the cost of ordering those devices. So you have an inventory that's decreasing. You don't have to pay for devices every month, but when you have to do the order, you have to pay for that. Cool. Awesome. So next up is the subscription. So what percentage of your customers need a subscription? In this case, we're saying that 100% of customers need to buy a subscription or will be buying a subscription. Let's say that it's 50% instead. Okay. So what's the average subscription price? Let's set that to $4.99. We're billing that monthly. You can change that to annually if that's the expectation. And then what's the expected monthly churn rate? So that is essentially the business model. So how we make money and what's the pricing. Now let's look into distribution. So distribution in the self-service model could happen in 3 different ways. We talked about organic traffic. So basically organic traffic is what percentage of your organic traffic converts into paid. What percentage of the traffic that you put through your website ends up converting organically, right? This is specific to the organic traffic. Right now we're saying it's 0.5%. Also, we have paid traffic. So paid traffic will be traffic that you push to the website via, social media ads, Instagram ads, YouTube ads, Google ads. So these are clicks quite literally. And the budget works same as before. We have a budget, $1,000 budget that increases by $1,000 every month, gets to a maximum of $60,000, and that budget is added here in the SG&A. So as you can see, that budget is just being accounted for. So if you go to projections, we also have the cost of acquisition. So out of this money that we'll be paying in traffic, what is the expected cost of acquisition for a sale? Now, right now, the placeholder was $99, but since we're selling a product for $49, where we only have a margin of around $30 after the shipping and manufacturing costs, we also have a lifetime value coming from the subscription itself. So the average lifetime value right now is $124. Basically, we're saying that the average value of a customer to us is $124, assuming that they buy a subscription, right? That's accounting for the fact that only 50% of them buy a subscription, sorry. So, this cost of acquisition seems reasonable, right? Because we were saying that we're charging, that we're gonna end up paying $99 per customer acquisition. And we can say that that number could maybe improve, maybe as we get better in advertising. So we could say that number is going to decrease by $1 down to a minimum of $80 per acquisition. And that's the expectation. So if you go to revenue, you'll see that. Let's look at organic. Well, we have paid traffic first. Sorry, we have $99. That budget is decreasing, and then based on the budget, we have the number of sales. So obviously, as the budget increases, we're going to see more sales coming from organic. Sorry, from paid. Then we have organic, which is correlation between the amount of organic traffic and the conversion rate, which is 0.5%. Those are the hardware sales from organic. And then finally, we have retail. So retail is very interesting because you don't have control over retail, right? As a company, you can't control how many sales happen on retail. It's a little bit of a brand awareness thing, but it's also shelf placement and that sort of thing. So if you are doing retail, you can define a number of sales at launch, depending on how many locations you have. You can define an amount of growth of sales, and then you can cap that growth at a certain amount every year. So for example, you could say that in 2021, we are going to cap that at, say, 250. So that's at launch, maybe we're going to do 100, and that's going to increase by 10% until it gets to 250. And we don't expect that we'll be able to sell more than 250 devices per month on retail. And that number could increase. And then next year we expect we'll be selling 1,000 devices a month. Next year it could be 2,000 and so on and so forth going up. Again, this is speculative and placeholders, but what you'll see here in the model is that on the self-service part, you'll be able to see the sales coming from retail. And that's going to be a percentage growth until it reaches that cap, right? If it reaches that cap, then it doesn't grow beyond that. That's the magic of that. Cool. So moving on, so what we'll have is a total number of hardware devices sold, and that of course is automatically connected to your inventory. And as your inventory needs to get bigger, as you need more devices, your orders are going to get bigger. And then the revenue from those hardware sales, of course, assuming the cost per sale or the cost per device. Then out of those sales, we're saying that 50% of them we expect are going to be converting into a subscription. So those are the ones that convert into a subscription, and here's the monthly billing model. So we have new customers added, lost customers due to churn on the subscription, and total customers active on a subscription. And you'll see that number grow. Number of subscribers. So that gives us MRR, which is monthly recurring revenue, gives us lost MRR, and then it finally gives us total monthly recurring revenue on the platform, which grows to 250K towards the end. That works for annual as well. So if you go with annual, and you can switch that here, the churn will be accounted for annually rather than monthly. So make sure that you adjust that. And then same as before, you'll see the number of customers converting and then the number of customers renewing for every cohort. What's important here is that if you bill annually, of course, your cash flow is going to be more significant. You're charging for 12 months on month one, so you're actually collecting that cash flow into your business. So your business actually generates a lot more cash via the annual plans versus the monthly plans, but that's if you can get away with selling annual subscriptions. Okay, cool. So that's that for the self-service model. Again, traffic driven by paid, organic, and retail if needed. Let's go ahead and disable this and move into the inbound sales model. So the inbound sales model is for potentially more expensive, more complicated, more specialized devices. And the way it works differently is it doesn't assume that the customers are purchasing the devices on their own. It assumes that people come to the website, they become leads, and then there's a sales team there's an in-house sales team that reaches out to those customers, or they book a demo, or they book a call, and you actually demo the product for them. So just like before, we have a launch date. We could have a different manufacturing cost. So of course, if you're doing sales like that, potentially your product's going to be much more expensive. So let's say that that's a $7.99 product to the customer that costs you $25 to produce, $20 to ship, that you need to order a few still. Minimum inventory order still applies. And then there's a 3-month manufacturing time. Again, these are all placeholders. And if you go to cost of goods sold, you'll see that here as well, right? You'll see the number of orders that you need to set up. And in this case, those orders do mean a significant dip in your cash flow, right? We're talking $125,000 in manufacturing costs that you will need to account for. And hopefully that's the idea with this model, that it lets you estimate those things. Okay? Then we have the subscription. And by the way, in this case, we assume that everybody that purchases a hardware device goes to a subscription. So let's assume 100%. Great. So next up is ARPU. So that's the average subscription price, average revenue per account. How will you primarily bill your customers, monthly or annually, just like before? We have a churn rate, which should be lower if this is a B2B product. Okay, and then let's look at the conversion funnel. This all works the same, by the way. So if you go to revenue, you'll see just like before, you have number of conversions, total hardware sales, revenue from those sales based on the pricing, and then how many people convert to a subscription, which is right now 100% of them. Then we have churn rate, subscription, MRR, and all that, just like before. The difference here in this model is the acquisition. So the acquisition happens differently. The acquisition and the inbound sales happens due to, again, people becoming leads. So what we have here is the organic traffic and how many of them convert to a lead. So how many of them give you their email or their phone number for you to reach out to them. And that's coming from the organic traffic. That's why the organic traffic metric was sort of like a global thing, because it could affect both. If you have both of these enabled, organic traffic is going to affect both of them. So on organic traffic, how many of them are converting to lead? We're saying that 1% of them become leads. With paid marketing, just like before, we have an amount of budget, starting, monthly increase, maximum budget, expected cost per lead. So this is not a cost per sale, this is a cost per lead. And we're saying that the cost per lead is 50. That number is going to decrease by $1 every month and get to a minimum of, 25. So if you go to revenue, you'll see here on the cost per lead, on the paid cost per lead, we have the cost of acquisition. That number is decreasing, again, from the original, which was 50, down to a minimum of 25. And at the same time, the budget is increasing as we were able to set up here on the budget. Great. Okay, so what happens? We're generating leads from paid traffic. We have 600 leads here. We have 23 extra leads from organic traffic. And then the total number of leads generated is 717 leads. But now, what happens with those leads? We have to get somebody to call them and to close the sale. So what we have here is you'll be able to select what agent from your team is in charge of that. Right now, we made it a default, the inbound sales agent. You can come here to Teams and Salaries, look at the inbound sales agent, and assume, and you set the settings for this agent. You can define their annual salary, their benefits, and you can even define additional agents that get hired. So I could, for example, come in here and say, well, I'm going to hire one person in January, so I can start training them and so on. I'm not going to hire anyone else, so I'm going to keep this to never. Then the maximum team is going to be 1. Their annual salary increase is going to be 5%. So I'm going to have an inbound sales agent regardless of what the model estimates. And then the model is going to estimate how many additional agents I'll need to be adding. So these add up to the ones that we are defining here in projections. So what we have here is the lead to sale conversion, right? So out of those leads that we processed, how many of them convert? And on the number of agents, this is the metric that defines it. So how many leads can a single agent handle per month? Right now we're saying it's 100. Maybe that's, 200 leads. Maybe not all of them need a call. So with that number, what we do is we automatically estimate how many leads you need. If you have 700 leads, the estimation is that you're going to need 4 agents to handle that. So those 4 agents are going to be automatically added to your headcount here, agents, including the one that you manually defined, right? So those are going to be added together. And then your model says that towards the end of the model, 7 years into this, you're going to need around 11 agents to handle all your calls. That, of course, depends on traffic. So, more leads will automatically translate to more agents. So we have a conversion rate. So how many of them convert? How many of the leads that you generate convert into a sale? And that's a hardware sale. So that's 72 based on a 10% conversion rate. and then how many of them get a subscription, as I mentioned. So you could set this to 50% if you want, and then that's just going to translate into how many of them actually go to a subscription, either on the monthly model or the annual model, as I explained before. All right. Just a couple of extra settings out here. We have the per desk cost at the office. So for every headcount, we're going to add a cost per desk. That's assuming that you're in a WeWork space, or even if you're not, even if you're in a traditional office, probably your office space is, you can come up with a number on how many dollars per employee you're paying on the office. And then finally, we have the tech support and customer success agents. So what we're saying is, for every X number of customers that are active, how many agents will I need? So you could say that, for every $1,000, I'll estimate that I'll need a new customer support agent. So the way that works here is the number of customer support agents gets scaled automatically based on the number of sales that you're generating, which is a really useful thing to sort of scale and understand how your team needs to scale as your business moves forward. Once again, that all gets added here and added up to your total revenue. The check that you can make is go to a random month and say, okay, let's go to October 2026. Right now, you can even play around with that on just figuring out if your hardware sales are giving you a margin. So for example, you could say that nobody gets a subscription. So we can say that on this inbound sales model, 0% of people buy a subscription. So it's just a hardware product that has a $500 margin, which is pretty good. And you can even test that model. So you can go to financial statement month and figure out if your business is profitable with that. It seems that it isn't. So the cost of selling that product, adding up to the cost of payroll, which is sales agents, it doesn't seem to be driving profitability for your business. So you need at least, say, 50% of those guys to get a subscription. You can play around with the subscription price as well, just to understand where is that little balance where that translates into profit for you. So in this case, we have profits. We have 86% profit margin on COGS. Sorry, that's summary. The average, 93%, average profit margin even after manufacturing costs. And then the EBITDA margin is in the 76% range. Why? Because the subscriptions are sort of making up for that cost, which is great. All right, so that's that for the model. Just a quick note, if you have any questions or you need any help from our team in solving maybe some customization or an additional question, you can book us through here. So you can go to the welcome page and book a call with our team. They'll be happy to help and answer any questions that you might have. Thanks a lot for watching. We'll see you next week.